Hello, and this is part 2 in my 5-part series on surviving this bear market, actually profiting from it, which is what 90% of people are not going to do, but you can do it. Now, in this segment, what I want to talk to you about are the technical indicators that I use to spot bear markets and try to figure out when the bear market rallies are going to end and when the bear market as a whole is going to end. And there's several indicators I follow, but in a short video I really can't talk to you about the two most important ones. The first one is the 200-day moving average. That's the average of a price for a market, an index, or even an individual stock, and you plot that out on a chart. If you have a stock chart like this, you'll see a line that's smoothed out, and that's the 200-day moving average. It can be 50, 25, but for the long-term trends I use the 200 and also use 150, but we'll just talk about the 200 right here to keep things simple. Now, on my website, I have this stock market mastery course in which I devote an entire lesson to this 200-day moving average. And you can also see me in some of my earlier writings this year talk about the 200-day moving average. Back in October and November, I did a whole series about, hey, this is what the 200-day moving average is doing. It's warning us that a bear market's upon us. If things don't change by the end of December, then we're in a bear market. Now, go on the internet if you want to and type in, go to Google, type in 200-day moving average, study what it is, and you'll be able to visualize it. But the way I can explain it to you, and I do want you to jump off after this video and do some looking and research, and you go to WallStreetWindow 2, type in 200-day moving average on the search box, and you can find some articles I've written about it, probably these ones that are closer to this time frame and talk about the market and the bear market now. But basically, the 200-day moving average has a pattern to it like this. When the moving average is going up, that means that the stock or market is in an uptrend. The moving average is going up at this kind of an angle like this. It's pointing up. Now, and what tends to happen in these environments is this is a bull market, and the 200-day moving average tends to act as support during this time. And if the market comes down to it, it may go through it, but it only will stay down there for usually 2 or 3 weeks at the most. Over the past 40, 50 years or so, it's never stayed below that level more than a month if you're in a bull market. So after you have this stage of the 200-day moving average going up inside of a bull market, you reach towards the end of a bull market and the moving average will slope out like this. And the market will touch it multiple times. And then as the market tops out and the stocks decline, the moving average points down, and that's when you're in a bear market, and the moving average then will act as resistance. You often have several rallies back up to the moving average, but the market fails to penetrate it and continues lower. In fact, that's exactly what we saw just now when the S&P 500 rallied up to the 200-day moving average. The Dow didn't even get to it. The NASDAQ went through it for a couple of days and then reversed course. So we saw a bear market rally where, bam, we went up 200-day moving average, it came back down. Now, the thing about October, what I was telling people back then is, the market, the moving average is going like this, the market fell through it, and I told everyone, look, I believe this was in November, that if the market doesn't reverse course and get back above this moving average, it's going to start to slope down. And you see this in bear markets, and that's going to be a giant warning sign for all of us that we're going to have to heed. And when we did that, I told people what I was doing. I was going to cash at the end of December. I did miss a rally in gold stocks in the first part of January and oil stocks, commodities, but I just sat in cash and waited to January and picked that bottom in that rally. I didn't make a whole lot of money on that because I tried to ride it up too long and reversed, and I lost most of my profits, but I did get in near the January bottom and did that. But March came and the market had a steep correction into March, and then we had another rally back up to the 200-day moving average. And really, in these market environments, you want to stay with the bigger trend, so you want to short if you're interested in making money. So that's what I did. I shorted at the 200-day moving average, and now we're going to have to see how much the market is going to drop, and I expect it's going to drop fairly substantially, and I'll explain to you why in the next video. But I want to make one final point, about the 200-day moving average and talk about the other indicator I haven't gotten to yet. When you get a final bottom in a bear market, what will happen is that this 200-day moving average will tend to flatten out for a period of 3 to 6 months. And during this time, the market consolidates and goes into a sideways pattern, and then finally it breaks out and goes to the upside. That breakout causes the 200-day moving average to begin to slope up, and that's the beginning of a bull market. And that's what we're going to see when this bear market comes to an end, several months after the final bottom. Now, the most important thing that you need to do is preserve your capital so you can take advantage of the market when we get to that situation where a true bull market is about to begin, not simply a bear market rally that really screws people over. If you can simply go to cash even and just preserve your money, you don't even have to try to make money shorting. If you just do that, you can make a killing when the next bull market starts, because you'll be able to get in near the bottom. Now, I doubt very many of you are going to want to be patient for that long, so I'm going to tell you ways you can profit in the last video here. Now, quickly, I want to talk about the other indicator that I closely follow, and that's the advanced decline line. That's the number of stocks that are advancing and declining in an index. And I track this for the S&P 500 and for the NASDAQ. And what this means is if the market's rallying and this advanced decline line is rallying with the market, that there's heavy participation. Lots of stocks are going up with the market averages. Now, if you get to a point where the market is going up and this advanced decline line diverges and declines while the market's going higher, that's a danger sign that you're in the latter stages of a bull market, because of what it means is leadership is narrowing, fewer stocks are participating in the bull trend. And we actually saw that begin in the stock market last year about this time, a year ago, way before the market topped out. Most stocks and sectors were actually in declines way before the market averages were. Now, what tends to happen in bear markets is that these advanced decline line indicators don't turn up, they don't begin uptrends throughout the entire bear market until the next bull market really begins. Now, you can look at the advanced decline line. If you go to stockcharts.com, on the right there's a box, and there's, I believe, two things. I don't remember what the first one is, but one of them says market breadth. Click that and you're going to see these indicators for all three major market averages. Now, interesting enough, what's happened on this rally is that if you take a look at the NASDAQ, the advanced decline line did not follow the NASDAQ. And there's another indicator, ratio of new highs to new lows. It actually was making new lows while the NASDAQ was going up. What this means was that the NASDAQ was actually the strongest of the three major market averages, but most stocks in the NASDAQ were dropping. So the strongest market average had widespread weakness within it. And if you break the NASDAQ down, what you'll find is that from March to the peak, 50% of the gains in the NASDAQ were due to Apple, Google, and RIM. Three stocks powered almost the entire rally in the NASDAQ. Now, I want you to think about this, and that's really, really bad. You don't see that during the beginning of bull markets. You see that in bear market rallies. Now, here's the thing. Back in August, we had a major correction, scary correction, in fact. And then we had a rally from August to October. The S&P 500 topped out before the NASDAQ did. Now, guess what? Guess what led that rally? Google, RIM, and Apple. Those three stocks, the same thing happened. They're responsible for the bulk of the gains in the NASDAQ, which was the strongest market average. So this is a very bad sign, to say the least. And I want you to be aware of it and don't get fooled. Don't get trapped thinking you're going to miss out on the next bull market, because all signs that I'm looking at suggest to me that this bear market is going to continue, and you have to be aware of that. And in the next video, I'm going to tell you about the fundamental causes of this bear market and where we can expect it to bottom at and when.